Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at the United States Oil Fund.
If you find our talks useful, please consider subscribe, like, and comment underneath. And, well, let's just jump right in today because we have to. At 6:00 a.m. this morning, global energy markets, they effectively broke.
Yeah, that's an understatement, honestly.
Right, like West Texas Intermediate crude, it didn't just gap up, it violently surged 8%. It blew past $104 a barrel before most of Wall Street even logged on.
Oh, totally. People were waking up to just absolute chaos on their screens.
Exactly. So, it's April 13th, 2026, and today we are unpacking this really aggressive 9 out of 10 bullish swing trade thesis. And it is centered entirely on the United States Oil Fund. We're looking at how this massive geopolitical supply shock is just being digested by the market. And why this specific fund has suddenly become the absolute center of gravity for both retail and institutional capital.
Right. And to really contextualize a single session 8% gap up, in a commodity as massive as crude oil, you have to look at the sheer scale of the macro shock here.
Yeah, the catalyst.
Exactly. So this morning, President Trump announced a U.S. naval blockade of the Strait of Hormuz. And regardless of the politics there, we're just looking at the market impact. And for anyone tracking global trade routes, that specific waterway is the world's most critical oil choke point.
It's massive.
It is. We are talking about roughly a fifth of the world's total global oil consumption passing through this one channel. And it's only, 21 miles wide at its narrowest point?
Something crazy like that, yeah.
So the market reaction we're seeing today, it's purely mathematical. The algorithms, the human traders, they're all instantly pricing in severe, immediate physical scarcity.
It's like, okay, think of it like a single derailed train on the world's busiest subway line, right in the middle of rush hour.
Oh, that's a good way to put it.
Right, because it doesn't just stop that one train. It immediately forces millions of stranded commuters to just aggressively bid up the price of literally every single alternative mode of transport in the city.
Exactly. The surge pricing just kicks in everywhere.
Yeah, the whole system's pressure spikes instantly. And, that brings us to the United States Oil Fund, which, it's already up over 60% year to date.
Yeah, it's been on an absolute tear.
But here's my immediate pushback, and I'm sure people listening are wondering this too. If oil is spiking because the global supply artery is blocked, why are we looking at this specific fund?
Right.
Like, why not just buy traditional oil company stocks? If crude goes up, shouldn't you just buy the drillers or the refiners, the massive energy conglomerates?
That's the logical first thought, right. But buying a corporate equity, so an oil major, for instance, it means taking on this really heavy layer of corporate risk. And that actually dilutes your exposure to the actual commodity price.
Oh, interesting. So it's not a one-to-one thing.
Not at all. When you buy a driller, you are buying a business. So you have to worry about their specific capital expenditures, the competency of their management team, their dividend policies.
Right. Any regulatory headwinds they might be facing.
Exactly. And beyond all of that, there is a really significant lag time. Like, if crude prices spike on a Monday, that sudden profit doesn't just magically show up that day. It takes months for it to actually appear on a quarterly earnings report.
Yeah. An oil rig operator doesn't instantly double their profits on a Tuesday just because the commodity got squeezed overnight.
Right. They still have fixed price contracts and operational overhead. They're locked into things.
So that lag is exactly what traders are trying to avoid right now.
Precisely. The United States Oil Fund possesses this very distinct competitive moat. It's basically defined by immediate accessibility and immense liquidity. It gives retail investors and institutions direct exposure to the price of West Texas Intermediate crude without the absolute nightmare of opening a specialized futures trading account.
Oh, man. Yeah, futures accounts they're intense.
They are. Trading actual oil futures requires navigating heavy margin requirements, you're dealing with strict contract expirations, and you have to manage the actual theoretical risk of physical delivery.
Right, nobody wants a truck full of oil dumping in their driveway.
Exactly. So this fund wraps that exposure into a highly liquid, easily tradable equity vehicle. And during a volatility spike like this morning's, where capturing that war premium is a very time-sensitive priority, liquidity is everything.
You need to be able to get in and out quickly.
Right. You need an asset base massive enough to absorb hundreds of millions in inflows without dealing with, huge bid-ask spreads or excessive slippage.
Okay, so we understand the macro shock. and we get why this fund is the default vehicle to capture it. But looking under the hood of this specific fund, it reveals this structural quirk that is actively supercharging these returns right now.
Yes, the mechanics here are fascinating.
Because this fund doesn't operate like a normal company, right?
Yeah.
It doesn't sell a product. It doesn't have earnings or revenue in the traditional sense.
No, not at all. The balance sheet is effectively cash, cash equivalents, short-term treasury securities, and WTI crude oil futures contracts.
Okay.
So the financial health of the fund is tied entirely to the performance of those underlying assets. And critically, the structural mechanics of the futures curve itself. Right now, there is this massive structural tailwind amplifying the fund's returns. It's known as backwardation.
Okay, let's unpack the mechanics of backwardation. Because from what we're looking at, it is the secret sauce of this entire 9 out of 10 bullish thesis.
It absolutely is.
It's one of those dry textbook terms. But understanding how it works changes the entire perspective on this trade for anyone listening.
Right. So in the simplest possible terms, backwardation is a market condition where the spot price, so the cost to take physical delivery of a barrel of oil right now, today, is trading significantly higher than the price of oil for delivery a few months in the future.
Everyone is panicking about today.
Exactly. It happens when the market is gripped by a sudden fear of immediate shortage. Refineries and logistics companies are basically screaming, "We don't care what oil costs next November. We need barrels right this second to keep our operations running."
Right. They can't afford to shut down.
Exactly. So they bid up that immediate price to an extreme premium.
Let me map an analogy onto this just to make sure the mechanics are totally clear for everyone. It's like having a hot ticket to a concert tonight. The concert is totally sold out. People are desperate to get in, so you can sell your ticket right now at a massive premium. But you also know the band is playing again next month. And nobody is really thinking about next month's show yet because they are all just, panicked about getting into tonight's show.
Right.
So you can buy a ticket for that future show at a steep discount. You sell the expensive ticket today, buy the cheap ticket for next month, and you just pocket the difference.
That is a perfect analogy. And that difference you're pocketing, that's what commodity traders call roll yield.
Roll yield, okay.
Yeah. Because the fund holds futures contracts that eventually expire, they can't just hold one contract forever. They constantly have to, roll their positions.
Right, before the music stops.
Exactly. So before a near-term contract expires, the fund sells it. And then they use that capital to buy new contracts further out in time. In a steeply backwardated market like we have right now, the fund is systematically selling high-priced near-term contracts and buying cheaper deferred contracts.
Wow.
And that continuous positive roll yield, it actually enhances the total return of the fund well beyond just the spot price of oil going up.
That's incredible.
Yeah.
So if the fund is continuously selling high and buying low, just through the sheer mechanics of maintaining its portfolio, it's effectively getting paid a premium to just wait out the duration of the blockade.
Yes, it acts as a massive structural advantage. And to really understand the power of it, you just have to look at its inverse, which is a condition called contango.
Contango, right, where future prices are higher than spot prices.
Exactly. Think back to the infamous oil crash of early 2020. The market was in severe contango then. There was way too much oil and literally nowhere to store it, so spot prices just collapsed.
I remember that. People were paying you to take oil.
Right. And in contango, a fund bleeds value every single time it rolls contracts because it's forced to sell cheap near-term contracts to buy expensive future ones. But today, the paradigm is completely inverted. The panic for immediate physical barrels has driven the spot price so high that backwardation is incredibly steep.
Okay, so if the market is screaming for oil today and backwardation is locking in those structural profits, how is that actually manifesting on the charts? Because looking at the tape this morning, and the price action isn't just, a gradual climb, it's violently aggressive.
Oh, yeah.
We broke cleanly above the $106 resistance zone on massive volume.
And that technical breakout is highly significant. When an asset gaps up 8% in a single session and shatters a major resistance ceiling like that, it usually signifies the initiation of a new, sustained momentum phase.
Driven by the big players, right?
Exactly. It's driven by institutional repricing, not just a temporary retail blip. The algorithms and large-scale asset managers are recalibrating their models right now. If we look at the core moving averages, the 50-period moving average is currently sitting near $103, and the 200-period is down near 95.
Okay.
So in the context of a macro shock, these moving averages transition from being overhead resistance into dynamic support floors. As long as the price sustains itself above that $106 level, the path of least resistance for the algorithms is decidedly higher.
Right. And, we really can't analyze this morning's breakout without discussing the massive bear trap that was set last week.
Oh, the bear trap,
Because
yes.
just a few days ago, oil actually plunged 12% on what turned out to be false peace hopes. There were whispers of diplomatic de-escalation, the market bought into the narrative, and the price absolutely plummeted.
Yeah, and the mechanics of that 12% drop are really what set the stage for today's explosion. Short sellers jumped into the market heavily last week. They were placing aggressive bets that the geopolitical crisis was fully over and prices would revert to their historical mean.
Right, they thought they had it figured out.
They really did. But when the concrete reality of the naval blockade hit the wires this morning, all of those short sellers were instantly trapped on the wrong side of the trade.
Ouch.
Yeah. They are now facing theoretically infinite risk, and they are being forced to buy back their positions at a steep loss just to cover. And that forced buying from panicked short sellers, it acts like high-octane fuel being poured directly onto an already raging rally.
It's the classic rubber band effect, right? The price was pulled back 12% last week, creating all this invisible tension in the market, and today it just snapped forward violently, hitting the short sellers right in the face.
That's exactly what happened.
But, this dynamic brings up a critical technical red flag that I think we need to talk about. The RSI, the Relative Strength Index. It measures the speed and magnitude of recent price changes to evaluate whether an asset is overvalued. And right now, it is pushing deep into heavily overbought territory.
It is.
So if the indicator is screaming that this rally is moving too fast and we are witnessing this much intense fear buying, aren't we risking buying the exact top of a panic bubble?
It's a fair question. In a standard low volatility market environment, an overbought RSI is a clear technical signal to take profits and step back.
Right.
But technical indicators have to be contextualized against underlying fundamental realities. We are not in a normal market right now. We are in the epicenter of a structural physical supply shock. Furthermore, there's a tectonic shift happening underneath the surface of the broader market. It's commonly referred to as the Great Rotation.
Great rotation. Okay, let's talk about that.
So institutional investors are actively fleeing high multiple tech and growth stocks, and they are pivoting hundreds of billions of dollars of capital into old economy value plays, specifically energy majors and commodities.
So the immense volume pushing the RSI into overbought territory isn't just day traders chasing green candles. It's the biggest funds on Wall Street fundamentally reallocating their entire portfolios for a higher inflation environment.
Exactly. And the raw physical market data validates that institutional panic. The U.S. Energy Department announced they are loaning 8.5 million barrels of crude from the Strategic Petroleum Reserve to help stabilize the market.
Okay, yeah.
When the federal government is forced to step in and act as a physical liquidity provider of last resort just to ease domestic deficits, it confirms the bullish thesis. This isn't just paper speculation driven by Wall Street.
Yeah.
There is a tangible physical shortage of crude developing in real time.
Right, the Strategic Petroleum Reserve. But let's put that in perspective for a second. 8.5 million barrels from the reserve is basically a Band-Aid on a bullet wound when global daily consumption is sitting at over 100 million barrels, isn't it?
Oh, absolutely.
Like, it feels more like a psychological signaling tool than a mathematical solution to a closed Strait of Hormuz.
It is entirely a stopgap measure. Releasing 8.5 million barrels might slightly ease localized refinery constraints for, a few days, but it does absolutely nothing to replace the millions of barrels permanently removed from the global market every single day the blockade continues.
The math just doesn't add up.
Right. Because the math of the shortage is so stark, major analysts are rapidly revising their models. They're openly setting price targets up to $150 per barrel by mid-May.
Wow. $150 a barrel is a psychological threshold that sends absolute chills down the spine of the broader equities market.
Yeah, it does.
And the anxiety doesn't stop at the blockade itself, right? There's another layer to this narrative driven by the rumor mill.
Yes, there is. And while we have to analyze them strictly as unconfirmed market chatter, there are intense discussions on trading desks right now regarding the secondary ripple effects of the blockade.
Right.
Specifically, what happens if the U.S. Navy begins intercepting or blockading ships specifically carrying oil bound for China?
Oh, man.
The economic ramifications of that scenario are severe. If global supply chains fracture along geopolitical lines and sovereign nations shift from simply purchasing commodities to aggressively hoarding them for national security purposes, you introduce a hyper-bullish, virtually unquantifiable catalyst for crude prices.
Okay, so the fundamental scarcity is undeniable, the structural advantage of the fund is locked in, and the institutional money is clearly flowing. But to execute on this, if you're looking at your portfolio, we need to map out the precise timeline. Because given the volatility, this clearly isn't a buy and ignore it for retirement situation.
No, definitely not. The thesis defines this very strictly as an aggressive 1 to 3 month tactical swing trade. It requires rigid attention to the catalyst calendar.
Right, so what are the dates we need to watch?
The first major binary milestone is April 14th, so tomorrow at 10:00 a.m. Eastern Time. That is the exact moment the blockade officially takes effect. Binary events like this almost always trigger immense upside volatility as the market transitions from pricing in the probability of the event to pricing in the absolute reality of the closure.
Got it. And what happens mechanically in the days immediately following the closure? Because you can't just shut off a global waterway and expect every gas station on Earth to run dry the next afternoon.
Right.
There's a delay built into the physics of global shipping. Right?
Exactly, and that delay is exactly what the market is modeling right now. The projections indicate that by April 20th, the pre-closure barrels, meaning the oil that was already loaded onto tankers and in transit before the blockade went into effect, will be completely exhausted at their destinations.
Oh, wow. So that's the real crunch point.
Yes. That specific date is when physical supply chain stress transitions from being a theoretical future problem to an acute immediate crisis for refineries. We anticipate that April 20th inventory exhaustion will serve as the primary catalyst for the next aggressive leg up in pricing.
Okay. And colliding right into that exact same mid-April window, we have critical macro data hitting the tape, right?
Yeah.
The April Consumer Price Index and Producer Price Index data will be released.
Yeah, that's going to be massive. Current analyst consensus is estimating that U.S. headline inflation could push back up toward 3.5%.
Ouch.
Yeah. The recent surge in global energy costs is going to bleed heavily into that data. When energy spikes, the cost to manufacture and transport literally every other good in the economy spikes with it.
It's all connected.
Completely. This print is expected to heavily cement the narrative of sticky inflation among the Federal Reserve and the broader market. And historically, during prolonged periods of sticky, stubborn inflation, hard commodity holdings serve as the market's favored defensive hedge, which of course draws even more capital into vehicles like the United States Oil Fund.
Makes total sense. So the fundamental data, the structural tailwinds, and the technical setup are all just tightly aligned here.
Right.
But to be responsible, we have to flip the board and thoroughly lay out the bear case.
Always.
What breaks this thesis? What are the specific catalysts that would cause a 9 out of 10 bullish setup to completely unravel?
The absolute primary risk is a sudden diplomatic breakthrough. Geopolitical shocks are inherently fragile. I mean, we already saw a preview of how violently the market reacts to peace with that 12% drop last week.
Right.
If a lasting ceasefire is announced, the war premium deflates almost instantly. Now, the steep backwardation in the futures curve suggests institutional traders believe logistical backups and, elevated insurance premiums will keep supply somewhat constrained even if a political deal is struck today.
Okay.
However, a sudden diplomatic resolution remains the single largest immediate threat to the upside price action.
That makes perfect sense.
All right.
The tension suddenly leaves the rubber band, and the price just snaps back to fundamentals.
Yeah, that's exactly.
But there is a second risk embedded in this thesis, and it's a massive macro paradox, honestly. You noted that analysts are targeting up to $150 a barrel. But the data also shows that if oil prices sustain themselves above $120 for an extended period, it historically triggers a global recession.
It does.
So at what point does betting heavily on oil become a bet against the survival of your own broader portfolio? Like, if oil literally breaks the global economy and everyday consumers just can't afford to buy anything, does the United States Oil Fund still win?
That is a great point. That paradox is known in economics as demand destruction. And it is the ultimate ceiling on any commodity supercycle.
Demand destruction, okay.
Right. If crude goes to $120 or $150 and stays there, the entire macroeconomic machine begins to break down. Manufacturing output contracts, international shipping costs become entirely untenable, consumers dramatically alter their driving habits, and the global economy just grinds toward a recession.
Right, everything freezes.
Yes. And when that happens, aggregate demand plummets. That sudden lack of demand eventually offsets the supply constraints caused by the blockade, leading to a catastrophic crash in the price of oil.
Ah, which perfectly explained the time frame.
Precisely why this is explicitly categorized as a 1 to 3 month tactical window. You are
Hmm.
targeting the immediate acute supply shock and the resulting institutional panic. You are actively not making a long-term bet that oil stays at $150 forever. Because if it does, the resulting macroeconomic devastation will eventually destroy the very consumer demand that is currently keeping the price elevated.
That is fascinating.
Yeah.
All right, let's bring all these moving parts together for everyone listening and distill the most critical takeaways.
Sure. So we're currently witnessing a historic fundamental supply shock colliding with a distinct structural market advantage. The fundamental shock is the physical blockade of a vital global artery, creating immediate scarcity.
Right.
And the structural advantage is the steep backwardation of the futures curve, which allows the United States Oil Fund to systematically generate positive roll yield while simultaneously tracking the explosive upward price action of the commodity itself.
It's a perfect storm.
It really is. However, this environment demands intense vigilance. This is a highly aggressive 1 to 3 month tactical hold. The primary roadmap requires monitoring the immediate volatility of tomorrow's April 14th closure, tracking the physical inventory exhaustion hitting around April 20th, and keeping one eye permanently fixed on geopolitical headlines for any signal of a diplomatic off-ramp.
It is an incredibly layered dynamic. You have the suddy squeezing of global trade, you have institutional giants rotating hundreds of billions of dollars out of growth and into energy, and you have this specific fund functioning as the primary pressure valve for all of that incoming capital.
Absolutely.
But, looking at the sheer scale of the disruption leaves me pondering a much broader, longer-term question. We've defined this as a tight 1 to 3 month tactical trade. But as staggering energy costs migrate deeply into the foundational layers of the broader economy over the next quarter, and inflation proves to be stubbornly permanent, are we actually witnessing a multi-generational reversal of market dynamics?
It's a huge question.
Could hard assets and old economy commodities consistently outpace tech and growth stocks for the next decade due to a permanently fractured global supply chain? Because when an artery as critical as the Strait of Hormuz gets violently pinched off, even if it eventually opens back up, does the global circulatory system ever truly pump the exact same way again?